to that in the next few weeks. But that's also a country, the role of which we will be looking at very carefully. Thank you.
Thank you. And the next question goes to Marta Izan of the Spanish Negocios TV channel. Marta.
Thank you so much for having my question, for taking my question, Mrs. Lagarde. I know you just said you're not going to compare with the US, but Powell said yesterday that the economy's disinflationary process has started. How far is Europe from being able to say the same? And another question, you said the decrease in inflation rate is primarily related to energy. So does this mean that the decrease is not due to the actions of the ECB? Do you expect the 2% in the medium term? And what is exactly the medium term?
Far from me to say that monetary policy is not potent and efficient. I think that what we are seeing in our bank lending survey, in the cost of financing in particular, is clearly an indication that there is transmission of our monetary policy and our interest rate hikes decision, clearly. So that is definitely working. But it's also true that a large portion of that too high inflation was attributable to the supply shock provoked by very high energy prices, and one that we did not really capture so well, which was gas prices and the impact it had on electricity cost. So we have to be attentive to those energy components, and we have to be attentive to the pace of transmission and the pass-through of those costs into other inflation component. But I would certainly not say that the disinflationary process at large and without qualification is already at play. When I look at core inflation, which is, by far not the only component that we look at many more of those. But when I look at core inflation, we were at 5 in November, moved up to 5.2 in December, stayed at 5.2, and this is the highest in all time that core inflation has been in our part of the world. So I get it, headline inflation has gone down, and more so than we had expected, and that many had expected, but underlying inflation pressure is there, alive and kicking, which is why we are committing as we intend in this monetary policy statement, and this is why I say that we have more ground to cover and we are not done.
Thank you, Madame Lagarde. And the next question goes to Jan Marlin of Handelsblatt. Jan, please.
Hello, Madame Lagarde. Thank you for the opportunity. In the statement, you described the risks to the inflation outlook as balanced.
No, I say more balanced.
More balanced compared to December. Could you say something about how important that is for the future rate path? And my second question also relates to that. Was that controversial within the Council? Were there different views about that? Thank you.
Well, thank you very much for your question. I think the whole paragraph that you have in the monetary policy statement on risk assessment and I'm not going to offend you by reading it to you because I know that you have it, but it really focuses on in which way is this risk assessment more balanced, not balanced. We don't think that there is symmetry of risk, but it is more balanced than it was back in December, for sure. And it lists the various points that are upside risk, downside risk on both account on activity and inflation. Because my governors around the table of the Governing Council are genuinely interested in analyzing, understanding, and coming to as well-based conclusion as is possible, there was not a lot of discussion on that particular paragraph. It was a rather consensual assessment of the more balanced risk at this point in time. We will obviously reevaluate and assess again at the March meeting. Thank you.
Thank you. Returning back to Webex, I would like to give the floor to Fabrizio Goria of La Stampa in Italy. Fabrizio, please.
There you go. Hello, thank you, President Lagarde, for taking my questions. I had two questions. The one is about the BLS survey, and is about the credit crunch risks in the medium term. Do you see that? And the second one is about the TPI, the Transmission Protection Instrument, that you mentioned in the statement. In this case, do you see any risks of market turmoil in the bond market? Thank you.
Thank you very much for your two questions. On the bank lending survey, as I said to one of your colleagues, we draw a lot of conclusions, learning, understanding of how our monetary policy, and particularly the interest rate policy that we have developed ever since July, is actually transmitted via the banks to corporates and to households and to consumption loans as well. And we believe that this impact is, in a way, efficient and necessary given what we are trying to do in order to reduce inflation and bring it back to 2%. The transmission protection instrument that was put in place, just to refresh our memory, because that goes back to June, was intended, July, wasn't it? Anyway, it was about 6 months ago, was intended to protect the transmission throughout the entire euro area. And it is available, it is there, it will be used if necessary. It is not the first line of defense. As you know, we have flexible reinvestment under the PEP as the first line of defense. If we were to see that transmission being impaired for non-legitimate reasons, but it is there and it is available. We don't see a need to use it at the moment, but should it be needed, we will indeed use it. Thank you.
Thank you. And the next question goes to Takari Minami of Nikkei. Takari, please.
Good afternoon. Thank you for taking my questions.
Good afternoon.
And the investors and the financial markets expect that the ECB will finish raising interest rate in coming April, for example, by the meetings in May. So, as you mentioned, I know well, so it depends on the coming data, but do you think such expectations are correct or wrong? Thank you.
You know, I'll go back to what we intend to do, or what we actually shall do, not intend to do. We shall return inflation to 2% in the medium term, in a timely manner. And we know that to do that, we need to move into restrictive territories, to restrictive levels. And we know that rates are the best tool in order to do so. So we will use interest rate hikes in order to get to those levels. And as I said, we are certainly not there now, nor will we be in March, given that we will rely on inflation, underlying inflation indicators and pressure that we see very, very clearly nowadays. What will happen next, as I said earlier on, is going to be a factor of how much more ground we need to cover, and there will be ground to cover most likely, but it will be data dependent. We will look at all components, and it will depend on the interest rates, where we are then, and where we believe we need to be in order to deliver on our commitment. But that will not be enough. We will have to stay there. So it's moving into restrictive territory because we know that's needed, given the elements that we have. But it's staying there so that we are confident that we don't touch the 2% for a few weeks, a few months, but that we have confidence that we will stay at target. So I hope that satisfies your question. I'm tempted to ask you a question because we've been debating as to when the governor of the Central Bank of Japan, my good friend Mr. Kuroda, will have to step down, and there was big discussion internally in the House as to when it was, but you will tell me later.
Thank you. And the next question goes to Santiago Pinol of Market News International. Santiago, please.
Hi, good afternoon.
Good afternoon.
My question is following my colleagues too. It's on December you said that the ECB was going to raise rates 50 in February, possibly 50 in March, and possibly maybe in May. I was asking you, like, how is seen now May? Because I don't know if it's less possibly than it was in December. And also on bonds, I would like to ask you, like, ESG bonds are constantly linked with greenwashing. How will the ECB manage the increased reputational risk implied by tilting bond purchases toward issuers with a better climate performance? Thank you.
Well, thank you very much for your questions. I think in December we mentioned significant, we mentioned steady rate, steady pace. In a steady manner, I think that's what we had used. And I said later on that our determination should not be doubted. It was 15 December, 15 February, we're doing it, and we intend, which is strong, as I said earlier on, to do 50 basis points based on the underlying inflation pressure that we see, anticipate, and are not going to go away. I'm not suggesting that it will be steady pace for an ongoing basis. What we're saying here in this monetary policy statement is that we will assess the situation, evaluate our monetary policy path on the basis of our projection. It might be 50, it might be 25, it might be whatever is needed, whatever rate is needed. I should say whatever rates are needed. We have 3, and then at whichever pace, in order to deliver on our 2% inflation target in the medium term that we want to reach in a timely manner. And we are far away from that. Inflation is still far too high today, in particular when we look at underlying inflation components. So, did you have another question?
Yes.
Oh, yes, of course, yes. Are we at risk of greenwashing? You know, as determined as I've always been, and you know me, it's been more than 3 years now. So as determined as I am to deliver on our strategy review and the action plan that we have all agreed around the table of the Governing Council, to deliver in alignment with the Paris Agreement, equally, we have to manage risk. And managing risk, to me, is having as clear, as distinguished, as transparent information and disclosure as possible, a good understanding of the transition plan by the corporates that we eventually reinvest into, and a good understanding of the footprint that they have. And it will be on the basis of that analysis, our own, and also reliable analysis that will be provided by experts, that we will orientate our portfolio with a stronger tilting than we had so far. But we will be very attentive because it's just, we should not be accomplice to greenwashing, and it's a risk management principle that we have to comply with.
Thank you. And the last question is for Eric Albert of Le Monde. Eric, please.
Thank you very much. Good afternoon, Mrs. Lagarde. I'm here. A couple of questions. I'd like to come back to the fiscal message, the message you want to send to government. You said they should recalibrate. Is it really the right time to pull the plug when food inflation is at 14%? And energy prices are indeed going down, but are still hurting a lot of households. And the second question, if I may, is do you believe your course of action is basically in line with a soft landing? Because growth is basically zero already. Inflation is going down, and the hikes that you've put through will take months to really go through the economy. So is there a danger to go too far, basically, or does it look like a soft landing to you?
Great questions. On your first one concerning fiscal, I just want for everybody's good understanding, because it's a sentence that we discussed quite extensively this morning. It's in the section on economic activity. So it reads, and that's in relation to government support, that we say will shield the economy from the impact of high energy prices, you're right. But then we say, in particular, as the energy crisis becomes less acute, it is important to now start rolling these measures back promptly in line with the fall in energy prices and in a concerted manner. So it's not it's not asking governments to stop now, but they clearly have to align their fiscal support with the energy price impact at retail level when it comes to supporting consumers, and at corporate level whenever it hits corporates. But many of these measures were decided in the course of the budgetary cycle, which it starts in the summer, it's active work in September, voted in December, and the measures apply throughout the whole of 23. And what if that recalibration does not happen, for those measures that were not subject to variation of energy prices and therefore would automatically adjust, then the other measures should be thought through and reconsidered. Not with a view to remove the shields, but simply taking note of the fact that the shield is not as badly needed as it was. So I think that's our advocacy to governments, and it's something that we discussed with the president of the Eurogroup yesterday in particular. So on the monetary policy decisions that we are making, as I said, we are riveted to staying the course, to move into restrictive territory sufficiently, and for long enough so that we're confident that we return inflation to 2%. There are some good news because, growth, which was expected to be negative in the fourth quarter of 22, is eventually slightly positive. Now, we Europeans always beat our chest, and we're going to say that, well, if you take this out and this out and this out, it's not so positive. I think we should celebrate that we are not in negative territory on the growth front. Headline is going down, which I think is going to be important, in particular for the wage negotiations that will be coming up. But we still have underlying inflation factors that are strong, solid, and are not budging. So we need to do our job. We need to deliver on our mission.
Thank you. That finishes the press conference. Next meeting and press conference is 16 March. Until then, all the best to all of you. Thank you very much.
That was ECB President Christine Lagarde in Frankfurt, Germany. I'm Jonathan Farrow, live from New York. Let's get straight to it. Two quotes that matter in the last 24 hours. One from Chairman Powell, one from President Lagarde. Chairman Powell, the disinflationary process has started. President Lagarde, the risk to inflation and the outlook are more balanced. This is important. There is a difference between what central bankers tell us and what markets actually hear. The central bankers are saying this: Lagarde, we know we're not done. Powell, we've got more work to do. This is what the market hears. You're basically done. Here's the equity move about 16 minutes into the session. We're flying up 6 or 7 tenths of 1% on the S&P. On the Nasdaq, up another 2.2%. Meta, we'll talk about that in a moment. That is rallying, and rallying really hard. In the bond market, the rally continues, yields lower. In the treasury market and in Europe too, we're down 15 basis points at the front end in Germany, 252. In Italy, monster moves, down 33 basis points on an Italian 10-year, south of 4%, 396. Guess where the euro is? Euro dollar looks a little something like this, negative 0.7%. We had a little look at 110 earlier, now 109.16. The President, Christine Lagarde, had this to say.
It should be 50 this time around. It is intended to be 50 in March. Now you will say, well, yes, but what about after March? Does that mean that you have reached the pinnacle or the peak? No. No. We know that we have ground to cover. We know that we are not done.
Joining us now to discuss is Maria Tadeo, outside of ECB HQ. Maria, what do you make of that one?
Well, Jonathan, to me, this was on paper should have been an easy press conference because the statement put everything on paper again, very clearly stated. 50 basis points today, another 50 basis points come March. In the press conference, however, there was what I would say a very delicate balancing act with Madame Lagarde insisting we have to do our job, bring inflation back to target. We're not done yet, and therefore we have that commitment, but also suggesting we are data dependent too. She pointed to large consensus but did not use the word unanimity when it comes to the decisions taken. And then she also suggested there had been some divergence at the core of the Governing Council when it comes to the communications. So the way that the European Central Bank communicated not just this move, but the one potentially in March. Around the March decision also, she said intend to do something is a strong word, but it would not qualify as 100% done deal at times. So to me, again, it was a tug of war at times between wanting to sound very tough, this commitment line, but then also saying we have to look at data dependent, and at times that merits a revaluation of things.
Maria, fantastic coverage throughout the afternoon over there in Europe. Thank you. I'm pleased to say that joining us now is Pictet's Ala Hodja and Saul Buckens, Michael Purvis alongside us as well. To the both of you, I just want to start with the compare and contrast, and it's very much a compare exercise between Chairman Powell and President Lagarde. Take a listen to this.
The risks to the inflation outlook have also become more balanced.
The disinflationary process has started.
We know that we are not done.
There's work left to do.
Michael Purvis, the central bankers are saying one thing. Are you hearing something else?
Well, look, John, I think as there's a game of catch up here that between the ECB and the Fed. Christine Lagarde is still sort of where Powell was a little bit last summer here. I think Powell is in a difficult position in a way because he's got to manage the financial conditions, but there's only so much he can do on those lines because Christine, as the marginal hawk, right? She may not have been as hawkish as some might have guessed, but she is making the euro ultimately a little bit stronger relative to the dollar, and that's going to feed back into easier financial conditions. And I think the other thing is that the rates market over here in the United States is very much the positioning has been extremely bearish across 2s, 5s, 10-year future positioning. It's extremely bearish coming into this press conference, right? So the market reaction has to be contextualized, I think, for some of the simple fact that a lot of this positioning has been just super, super bearish. The other thing is that there is a very, if you look at the terminal rate pricing for the Fed, that has been rightfully or wrongfully, that's been very, very stable since November, right? And the timing of that is really focused on May and June. You don't have that with the ECB there, right? So that's ultimately going to help sort of, reduce Treasury volatility here in the United States. And it's also going to create sort of, more confusion, I think, regarding where the ECB is with respect to rates on a relative basis.
Mike, I want to get Ella into the conversation as well. Ella, your thoughts on the central bank decisions from yesterday and this morning?
Well, I mean, they've done everything they could to sound hawkish, and the market, as you say, has taken a very dovish interpretation, so it's very difficult to fight that. And to us, it just means that the market thinks we have peaked, or at least we are close to peaking. Now, how does that play out? I mean, we've been pretty much doing this soft landing scenario where everything sort of works beautifully, immaculate disinflation, as some might call it. And basically that does give, fuel to the rally, whether it's in rates core rates, or whether that's in equities, credit, etc., or even riskier currencies. So, look, the way we're thinking about this is the following. It's the jury is out in terms of are we going to get a recession, how soon in the US, and does that mean that the Fed will actually cut rates? Or is the stickiness in wages and a very tight labor market sufficient to keep the Fed tighter for longer? And we would probably stay with the latter risk. When it comes to the ECB, the key takeaway is they're sort of waking a little bit late to the party in terms of wanting to be more hawkish.
Yep.
But in reality, their constraints will limit how far they can go. But I do agree that we might get more volatility around European rates, and we're really sort of playing that on a relative basis. So we're using that market to sort of...
Hello, this is Bloomberg Television.
Incredibly painful stuff, Ella, if you're on the wrong side of this. The rally we're seeing at the moment, the S&P 500 up by more than 8% year to date. On the NASDAQ 100, we're absolutely flying by 15, 16%. Ella, are you saying you'd lean against that?
Well, actually, it's a little bit soon to do that.
Hi, this is Bloomberg. Do you hear me? Would you be able to turn your camera?
I think we may have a connection problem with Ella. Ella, I'm sorry. Let's go straight to you, Michael, on the same question if we can. The move we've got at the moment, Mike, we've got equities up year to date by 15 or 16% on the NASDAQ. On the S&P, we're flying as well. Would you lean against that, Mike?
Not yet, no. I think we've got a couple things going on here. The economic data in the U.S. was expected to contract quickly. It's contracting very slowly. The same thing can be said for earnings. There's a malaise, but it's not dropping like a stone. And against that, you've got a stronger European economy and the China reboot that's sort of underscoring global growth there. And you got a dollar that since October, November has been in a weakening trend there. So we're in a very different place here. Positioning again has been very bearish across not just rates but also in equities. So this thing is going to fly higher. I'm targeting a VIX to 15, maybe even lower for this move.
Wow.
But that doesn't mean we're out of the woods. That does not mean we're out of the woods.
I apologise for that connection problem. Michael Purvis there at Toolback, and to Ella Hodger as well. Ella, let's reschedule a conversation and hopefully we can catch up again soon. Some of these moves are absolutely phenomenal, not just in the S&P 500 or in the bond market, but in the NASDAQ off the back of this move in Meta. Shares soaring after the company reported better than expected revenue. The CEO, Mark Zuckerberg, striking a new tone with investors. Our management theme for 23 is the year of efficiency. There's going to be some more that we can do to improve our productivity, speed and cost structure. Ed Ludlow on the West Coast with more. Ed, you're going to be a busy man a little bit later this afternoon.
Yeah, and look, analysts are cheering this, the stock having its biggest jump in almost a decade, the focus on efficiency and cost cutting. Also a bullish forecast for revenue in the first quarter, right? 26 to 28.5 billion. Even the midpoint was above analyst expectations for that quarter, but the focus very much on operating expenses. 89 to 95 billion dollars in full year 23, a trim of 5 billion from their previous estimate. The stock is now up, John, pretty significantly from that November 3 low, but another way of looking at it is Meta adding $200 billion of market cap since that November 3rd low. The other big piece of news, of course, is Meta boosting its stock buyback authorization by $40 billion, adding to the almost $11 billion that was already out there in repurchase programs. How much is the market cheering that? The market loves buybacks. A surprise. Facebook, yes, the legacy platform Facebook hitting 2 billion daily users. That's a jump of 70 million from the same period a year ago. This is a social media platform that is 2 decades old, and you look at the sell side, they're saying, actually, Meta's responded, made product tweaks, and the consumer base likes it, the market likes it.
Ed, thank you, buddy. As always, looking out for earnings a little bit later from Amazon, Apple and Alphabet. Meta absolutely flying. Your day ahead looks a little something like this in your trading diary. President Biden discussing healthcare at 2:15 Eastern Time, followed by earnings from Apple, Alphabet, Amazon after the close. The US payrolls report coming up tomorrow. Look out for that. US PMIs and ISM manufacturing numbers as well. And finally, Fed Speak returning with President Daly to round out the week. Look out for our coverage tomorrow. Mohammed Al-Arian, Rick Reeder, Anastasia Amoroso, Mike Collins, all on deck following payrolls. Payrolls tomorrow. Looking forward to that coverage with you live from New York. This was the countdown to the Open. This is Bloomberg.
answers great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, February 2nd. Here are the top market stories that we're following for you at this hour. Hawks talk, markets rally. ECB, BOE, Fed hike rates by a combined 125 basis points. Equities rally and yields sink. We're going to try and figure out this disconnect. And the Adani contagion effect. Adani's stock rout hits $108 billion. We're going to speak to veteran investor in emerging markets, Mark Mobius, founding partner of Mobius Capital. And hey, Meta makes money. A company boosting its buyback sees revenue of as much as $28.5 billion in the first quarter. The three A's, Apple, Alphabet, and Amazon, are now on deck. From New York, I'm Alex Steele with my co-host Guy Johnson, also in New York. Welcome to Bloomberg Markets. I have no other word to say except nuts. This bond rally is nuts.
Is it?
Yeah, I think so.
Has something, the market is signaling something's changed. Is that the message that central banks wanted to send, that something has changed? I listen to Lagarde, I get ostensibly she's very hawkish, yet she's caveating everything very, very heavily, and I wonder whether other central banks have said the same thing, the Bank of England and the Fed as well.
But is that worth a 22 basis point move on the German Bund?
Maybe it does. If
So
something
is
has changed,
positioning so different that this is what would happen to the bond market?
So somebody put it well earlier on. We've gone from a situation where we were unconditionally hawkish. Now we are conditionally hawkish. And that is a different state, and the market is reacting to that. But I agree, it's a huge move.
Huge. We're going to break that down over the next couple hours as well and try and make sense of all of this. And we have some breaking here.
We do.
Next read. What do you got?
Factory orders a little weaker than anticipated. They come in at 1.8. Now that's up from a negative 1.8. The market was expecting plus 2.3 though. Ex-transports, definitely a little bit weaker there as well, which is interesting. In fact, ex-transport's much weaker, so there's probably a Boeing effect in there. Durable goods, 5-6 in line. Capital goods, these are the final numbers actually, look pretty much in line as well. I don't listen to me. This Mike McKee probably is the right person to talk to
I
about
don't
this.
listen to you normally, so
That's a
that all
good
tracks.
starting point.
Mike, well, let's go to you on this. Bloomberg's Mike McKee joining us. Mike, your take on the numbers.
They're actually not too bad because of revisions to prior months. The factory orders number was a negative 1.9% in the month of November, and now it is 1.8% positive. Now, most of this, as you saw from the ex-transportation number, which was down 1.2%, is Boeing. Boeing had a very good month in December in terms of non-defense aircraft orders, and so that made a big difference in terms of the overall level. But capital goods orders, the ones that essentially reflect what's going on with business spending, are down 0.2. That's worse in the final number here than in the preliminary minus 0.1. So businesses slowed down. We saw that in December, and that was not as good a news for the economy. But the number of the day that really got everybody's attention is productivity was up this morning in the fourth quarter by 3%. After a 1.4% gain, which was revised higher for the third quarter. So companies are doing a little bit better as unit labor costs moderate down to 1.1%. So maybe the attitude of Jay Powell and perhaps Christine Lagarde has a reasoning behind it. They can see progress being made.
Yeah, the market move today, Mike, is extraordinary. Alex and I were just talking about it. Bonds are rallying aggressively. Yields are coming down rapidly. The market always hears what it wants to hear. Did it hear the right thing? Is the market move that we are seeing today commensurate with a shift in policy that may or may not be there?
I suspect it is not. It's an overreaction. I mean, somebody did preface a question to Jay Powell yesterday saying, given that markets are poised to overreact to whatever you say. And I think that's what they've done here, because if the Fed is expecting, and I know that the ECB is expecting, that inflation isn't going to go down in linear fashion. We may get some bumps higher. And of course, if we see oil prices continue to rise, gasoline prices continue to rise, we're going to see some impacts on inflation just from that. So they're not going to declare victory yet, but they also can't deny that things have gotten better, and markets don't do nuance very well.
that, I think, might be the quote of the day. Markets don't do nuance very well. Mike, thanks a lot. Really appreciate it. Michael McKee joining us from Bloomberg. So let's turn to that. This is really our question, right? You got ECB, BOE, Fed, all hugging rates. And our question, we just heard from ECB President Christine Lagarde. Let's hear a little bit of what she was saying.
The Governing Council will stay the course in raising interest rates significantly, at a steady pace, and in keeping them at levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target.
Well, that takes us to the question of the day. Did markets get the right message from central banks? Joining us now to discuss is Bruna Skarika, UK economist over at Morgan Stanley. Bruna, it's easy to look at the move in the bond market and say, nah, markets totally got this wrong. But did central banks, were they able to be nuanced? Did they get the right message to markets?
Well, the Bank of England actually is a great example of a central bank that delivered what looks to be a pretty hawkish move, 50 basis points. That is a forceful response, as the Bank of England would say. Whereas on the other hand, their guidance, which is the portion of their decision that the market focused more on, was actually very, very dovish. In effect, the Bank of England from here is not committing to raising rates further. They said that they're willing to adjust the bank rate, which means in any direction, as necessary in order to meet their 2% remit. And they also added that in case there are upside surprises in inflation and in wage growth, which is of course especially important for the Bank of England, that they're ready to hike more, but they're not ready to respond forcefully, i.e. with a hike of more than 25 basis points. So a pretty dovish message to the market, essentially saying we might actually be done here while delivering a 50 basis point move.
Okay, the five-year gilt is down by 22.3 basis points. That's nearly a quarter point rate cut today, effectively being delivered within the market. Is that an overreaction to the scenario that you've just laid out?
Well, if you look at the front end, for example, the kind of front end pricing for the meetings ahead, I believe the market still expects the Bank of England on balance to deliver the 25 basis point move in March, which perhaps you could expect, would be slightly more ambiguous or in question given the guidance that the Bank of England provided. For example, here at Morgan Stanley, we do think they'll do another a final 25 basis point in March. But I would say while for the UK specifically, the market was expecting a dovish message, was expecting a dovish 50, the initial read was, this could be actually a very hawkish decision. We had 7 votes for 50, 2 votes for a hold, but from Davish, Cheniere and Dhingra, no one voted for 25. And then all of a sudden you dig into the details, and as I've said, the messaging was pretty dovish. So I'd say the market is catching on to the kind of change in the inflection in inflation, in labor market dynamics in the UK. And I think that is what the Bank of England wanted to temper their 50 with, and the market has caught on to that.
Okay, so I have to say something like Guy was right, basically, from what you just said. Is it the same case?
That's never happened before.
It is
ever.
untrue. I said it like one other time. So Bruna, is it the same case when it comes to the ECB? Like, did they actually say the right thing? Are the markets getting this one right?
On the ECB side, I believe the message was, we'll do another 50 in March, and they are still very data dependent. They're slightly behind the BOE and the Fed when it comes to entering the restrictive territory, so there's a bit more to go. So the market reaction perhaps looks a bit strange considering that they're pre-committing to another 50, but perhaps the tone of the messaging was not as hawkish as the messages they've given in December, when they really wanted to make the market aware that they are going to be more aggressive than what was priced in. So in that sense, perhaps the market reacted in the way it did just because of some of the nuances in the messaging that were put forward.
Bruna, which major central bank cuts first? The Fed, the Bank of England, or the ECB?
So at Morgan Stanley, we think the Fed is going to go first in December this year. For the Bank of England, we think they'll follow in February, and then the ECB, we think, is going to make its first move only in June, although the first move will be a 50 basis point cut. I think this reflects the dynamics and the inflationary pressures, really. They are subsiding, it seems, quite aggressively in the US, but when it comes to Europe, the economies, both the UK and the European one, are digesting still a seismic energy price shock. So it will take slightly longer for that stickier services inflation to fall to levels that the central banks here in Europe will be a bit more comfortable with and will embark then on cuts. As I've mentioned, for the Bank of England, we think that will be February, so slightly sooner, because here in the UK we have that core goods disinflationary impulse to a higher degree rather than in the euro area, where we do expect that adjustment in core through 2024 to be slightly slower and for the ECB to be the last one to pull the trigger on the cuts.
Bruno, great to catch up. Thank you very much indeed for your analysis. We really appreciated it after such a busy day. Bruno Scarica of Morgan Stanley, thank you very much indeed. Coming up more on our question of the day. Did the markets get the right message from central banks? Gargi Choudhury, BlackRock's head of iShares Investment Strategy Americas, joining us to discuss. That's next. This is Bloomberg.
I would put it this way, it's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. There's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast.
Will a slowing economy finally hit the U.S. job market?
The real test for the bear case seems to be jobless claims.
We need wages to come down pretty significantly, and I'm just not sure that's going to happen.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Have we returned to pre-pandemic labor force?
You could see jobs go down to, say, sub 100,000 in the next couple of months.
That'll get their attention on Wall Street.
The January Jobs Report, Friday on Bloomberg Television and Radio.
If inflation still comes down, continues to come down, then we're okay. But it has a long ways to go. I think that's what he's emphasized. So I think it's fine. I would wish he did a little bit more, but the markets were not wanting him to do that, so he did 25.
The stubborn part of inflation right now in the United States is on the non-housing services, core services, and that's more than half the index. And so if those prices don't start to moderate and inflation doesn't start to slow down there, again, the FOMC could have more work ahead of it.
They probably need a little bit more restrictive stance of policy. And in March, we'll learn a lot. We'll learn a lot about how they actually see this play ending.
Those were some of our Bloomberg television guests reacting to the Fed's rate hike and the Powell presser yesterday. So our question of the day, Did markets get the message right? Joining us now is Gargi Chowdhury, BlackRock head of iShares Investment Strategy Americas, joins us now. I say this looking at the 10-year bond yield, down 34 basis points. Where do you think the market got the right message? Where is it totally off?
Hi, it's great to be here in person with Guy and you.
Yeah.
So I'll say a couple of things. So on the ECB, the reaction in bonds and BTPs were definitely a little bit surprising. I saw the ECB as still remaining very hawkish. They're obviously going to continue to raise rates higher, and they're not signaling a pause by any means after the March meeting. Lagarde was very specific about after the March meeting, we will see how data evolves, and inflation, obviously, we saw this week running at 5.2%. On the Fed, though, I think there was a small, ever so slight shift in terms of an acknowledgement of the start of the disinflationary process. That word disinflationary was used 13 times. So a little bit maybe on the ECB side, I'm a little surprised by the bond market price reaction. On the Fed side, less so.
Okay, let's just quantify a little bit surprised. Is this an overreaction?
I would say for the bond and BTP markets, it would not surprise me to see some give back in the days and weeks ahead, given I do not think this was as dovish as the market is expecting it to be, or the market's reading it to be.
So then what's going on? Like, is this short covering? Like, what was positioning going into this that would cause this kind of move?
Yeah, partly, look, it's the market reaction is always a result of what we expect versus what we get. So perhaps the expectation was for a much more hawkish outcome. Perhaps the expectation, especially after seeing perhaps the Spanish CPI number, which we know is significantly surprised to the upside, perhaps the expectation of many market participants was a much more hawkish press conference, and that is not what was delivered. It can also be investors actually putting cash back to work. I think that's a theme that we've heard in your program and others of investors staying in the sidelines and perhaps reaching this level in interest rates where people are getting a little bit more comfortable that the end may not be in the near future, but it is nearer than it was in 2022. And I think that's certainly what's some of the pricing.
Are we at the point where we're pricing cuts, and and we seem to have moved on to that as the theme? And it feels like we're skipping we're going to stay on hold for a long time bit.
Right, the higher for longer.
Yeah, and where's that gone?
So I think that's where in the U.S. this expectation, so right now if we look at what the front end is pricing in, from where we are now, we're actually ending the year, so end of December 2023, Fed funds are expected by the market to be lower than where we are. That feels like it's gone a little too far. Now, again, some of that could be because, I've talked about the very attractive yields available in the very front end. Again, we don't mean Fed funds, we mean 2-year treasuries, 3-year treasuries, 2-year credit, 3-year credit. I think some of that is just cash being put to work in very attractive yields. We've seen that in fixed income ETF flows. But at the same time, to expect 50 basis points of cuts when the Fed was very clear that core services ex-shelter, which we know is a big component of CPI, remains high, was actually higher last month than the previous month, is a little too soon for the data we have at hand, which means that the February and March CPI becomes ever more important as it has been so far.
So how do you play this? So how do you play a market that constantly pushes the Fed, for example, or the ECB for that matter today? How do you play that?
Couple of things. So certainly recognizing that bonds have returned as a ballast in your portfolio. Now again, we've had a tremendous rally. We've talked about this bonds are back theme. So, continuing to own bonds when we see that back up. And I think we've seen that over and over again this year. Whenever we've seen even ever so slight move higher in yields, we saw that in December when 10-year treasuries got back up to 4%. Huge amount of inflows into LQD and TLT, which are obviously giving giving you that duration in the credit and rate space. So investors look to buy interest rates at any backup because they are giving you a really good ballast in your portfolio. The other, I would say, is still recognize the carry that even at today's yield levels, recognize the carry that high quality credit offers you in the market. So again, looking at a 5% yield in investment grade corporate credit, that's how you play it. Be ready to buy the backup in yield, maybe today's levels after these moves aren't exactly the right ones, but be ready to buy the backups.
A lot of people have came into the beginning of this year feeling quite cautious.
Yeah.
We've seen a huge rally in equities. The bond market's done what we've just been discussing. A lot of people were not quite still willing to chase it.
Yeah.
When do we get to the point where you just have to chase it?
I think we have gotten to the point,
Are
right?
we there? We're there yet? Yeah.
We literally saw that yesterday, where again, this wasn't a move to higher equity prices on small volumes. This was a move on very large size volumes. So this can't just be explained by short covering. This is investors looking to put cash back to work. It makes me a little cautious. It does make me feel like, chasing the rally at this point with earnings expected to still be downgraded just a little bit, with whether we want to call it a recession or not, and we're not using that word, but with a slowdown for sure from fourth quarter GDP, a slowdown still on way. I think it's hard to chase the rally, but I'll still say that remaining invested in the markets, that's always been our North Star. We think value probably does outperform in the higher for longer, or at least high for longer regime, and real rates still remaining positive, I think, is something that investors should take note of.
So many contradictory thoughts you've got to hold in your head at the moment. It's really complicated. So thanks for sorting it out for us, Gargi. It's great to see you in person.
Absolutely.
So nice to see you here in New York. Gargi Chaudhry of BlackRock. Still ahead. Talking of crazy markets, MetaShares, have you seen what is happening this morning? They're on track for one of their biggest daily gains in nearly a decade. More on what investors are liking from Mark Zuckerberg's plans. We're going to have a year of efficiency, apparently. We'll talk about it next. This is Bloomberg.
Silicon Valley has obviously failed in its mission to produce technology that's useful and useful for the world and makes it a better place. And we were, I think, the first reasonably large company to leave. And now I'm very happy to come back and say, look, on occasion, our position is a position we're proud of, and be surrounded again by people who disagree with me.
That was, of course, Alex Karp. He is the Palantir CEO. He was in an exclusive conversation with Bloomberg's Ed Ludlow. It is, I figured out where the clock is now, 23, nearly 24 minutes past 7 on the West Coast. The sun is rising in San Francisco. It is time for the startup. All the tech stories from the Bay Area and beyond. I suspect that everybody's talking about but one story this morning, though they have many more to come a little later on in the day, and that is the market reaction, Ed Ludlow, that we are getting with Meta. Oh my Lord. All you had to say was we're going to have a year of efficiency, and that happens.
It wasn't even a buzzword, it's the slogan of the year, and it sent the stock to its biggest jump in almost a decade. I think that, it's the language investors wanted to hear. Everyone was fed up with Meta's expenses with regards to transition to the metaverse. So what have they done? They've trimmed it by $5 billion for this year. It's still staggeringly high though, right? In the region of $90 billion in terms of OPEX for this year. But that's what Zuckerberg was saying, that actually we're not going to be compromising. We're going to be efficient and we're going to be ruthless, and we're going to focus despite the world being very exciting around us.
Like, who knew that the year of efficiency would be a positive? Like, that would be sexy enough for investors to bid the stock up 26% in 2 days. How does this set up Google, by the way, after the bell?
Yeah. Well, remember that Meta, while it was the third sequential decline of revenues in the fourth quarter, it still beat expectations, and the forecast for the first quarter, which is $26.5 to $28 billion of sales, was also above expectations. And you look at Alphabet, shares did jump in aftermarket. There's some feel good, but then the commentary on the call from the CFO of Meta was there's still weakness in some pockets of the advertising space. So this earnings season is all about how mega cap tech, the stalwarts of Silicon Valley, fare in a downturn. Meta's gone first and actually proven it's more nimble than we thought.
Today's all about the AAA.
Right.
Alphabet, which
AAA.
Alex, yeah, there you go. Alex struggles with that A because she thinks it's a G.
I do.
But anyway, we'll move on from that.
Okay.
So you've got Amazon, you've got Apple, and you've got Alphabet. Which of those is going to give us the best macro signal on what is going to happen in the economy?
Apple. Apple's a global company. Think about China, think about Europe, think about the US, and the iPhone 14. And we just talked about Meta. How does Apple fare in a downturn? There was serious revisions at the end of last year for how many units Apple would deliver of the low-end iPhone 14, while they were limited in their ability to build the higher-end Pro models. Tim Cook always says, I'm not an economist, and then goes on to give pretty detailed macro outlook. So I'm interested for the call, because actually this is going to be a year where Apple proves itself as well.
Great point, Ed. Love it. Thanks a lot. Bloomberg's Ed Ludlow joining us. Coming up, it is one of the biggest financial wipeouts in India's history. We're going to talk to famed EM investor Mark Mobius about why he steered clear of Adani Group. This is Bloomberg. got some breaking news for you here. Italy's 10-year yield set for the biggest drop since March of 2020.
The ECB just hiked by 50 basis points and said it's going to do it again. Effectively, we got a 100 basis point hike today from the ECB.
Also,
and that's what BTPs do.
Also, March 2020 was when the world shut down, and now we're looking at 36 basis points off on Italian BTPs. This is crazy. I think it's crazy.
It is a little nuts.
It is a little nuts. Okay, so that's the picture in the bond market. In the equity market, it feels just as kind of insane, sort of rejiggering positioning right now. NASDAQ 100 is up by 2.6%. We're going to get more into this right now with Abigail Doolittle. Abigail?
Well, Alex, that's a great way to put it. We really are seeing a repricing of risk relative to the S&P 500 and the NASDAQ, both up 1% or more. You can see the huge outperformance for the NASDAQ 100. It seems as though there's something for everybody in all of these central bank statements with the Fed. Some thinking Jerome Powell was hawkish, some thinking he was dovish. The dove's winning right now, I would say. And then take a look at Meta, up 23%. The last time I looked, the best day since July of 2013. I wouldn't be surprised if this is the best day ever at this point on the year of efficiency. Plus, of course, Meta did beat their fourth quarter revenue estimate, and they also authorized a $40 billion buyback. Not so shabby for those investors. Now, you guys were just talking about yields. Here's the 10-year yield here in the U.S. Not doing so much, down 4 basis points, but nonetheless, it had been at its lowest level since September of last year. So again, some dovish tone here. As for the 2-year yield, it's almost below 4% after being above 4% for such a long time. At this point here, you can see starting to hit into support. It's going to be interesting to see whether or not the 2-year yield goes below 4%. This chart suggests that it is, which again suggests that many investors think that the Fed is going to do some of these lighter hikes and then maybe pause. I won't comment on the idea that they're going to cut. That seems unlikely to my hearing of the Fed, but many do think that. Now, interest rates in, that of course means big tech is up, and take a look at this. These are the point contributions of some of the mega cap tech movers this year to the NASDAQ 100. We have Amazon, Nvidia, Apple, Tesla, Microsoft, all the big names there. Meta there in the middle too. On bottom, Netflix. But these are the old winners of the pandemic. Well, they are back. And on this, Alex, we have something pretty special for the S&P 500. Right now, we do have the S&P 500 really doing something that it has not done in quite some time. So I think we can make the call that the bear market is really starting to fade. This is a sign that we are actually starting to see the beginning of some sort of an uptrend, not just a sideways trend. You have a golden cross in the S&P 500. That's the 50-day moving average crossing above the 200-day moving average. You have the S&P 500 really taking out that October high. Net, Alex, this is very strong evidence, again, that this is not a bear market rally, that this could be the beginning of something new that the bulls will like.
Yeah, really unreal. Jay Powell not acknowledging really that financial conditions have loosened. Abigail, thanks a lot. Really appreciate that. So the crash in Adani Group shares started last week, and it really is picking up even more steam. Hindenburg Research, an American short seller, accused the conglomerate of fraud and manipulating stock markets. Now, Chairman Gautam Adani spoke in a recorded video address trying to reassure panicked investors after pulling a share sale.
The fundamentals of our company are very strong. Our balance sheet is healthy and assets robust. Our EBITDA levels and cash flows have been very strong. Once the market stabilizes, we will review our capital market strategy.
Well, veteran emerging market investor Mark Mobius has a large position in India, and he joins us now on the phone. Hey, Mark, good to talk to you. You didn't participate in Adani's stock sale. Can you tell us why not?
It's all about debt. I mean, the company and its associates are heavily in debt, and that's what sort of scared us away. In addition, we usually concentrate on smaller companies, but in any case, the real issue was this.
Mark, are you still there? We seem to have lost you.
The Indian market is big, and it's very interesting, you know.
Mark, is this an India problem or is this an Adani problem?
It's an Adani problem. India is going to still go from strength to strength. It's an incredible country, incredible prospects, high growth, young population. So I think it's just one of the typical scandals that you get in capital markets, and it'll pass. Let's put it that way.
Mark, where's the risk to contagion that you see? I mean, we see banks saying we're not going to accept debt or stock as collateral from other investors. Like, Is there a potential contagion effect?
Well, of course, the banks are now going to be much more cautious as a result of this, and that will impact some of the highly indebted companies. But those companies that have strong balance sheets and low debt will do very well, will continue to do well. You know, in any story like this, there are always winners and losers, and there'll be winners, that's for sure.
Mark, how should the Modi government be reacting? Because that feels like it could become increasingly critical here.
The Modi government, you know, is on the path to reform, and they're certainly going to look at this very, very carefully because they're quite concerned about the capital markets and the health of the capital markets. So in one sense, this is a very good situation where, you know, the government has now put it on notice that, hey, you've got to wake up to these situations and be careful about some of these companies that are heavily in debt. So in that sense, it's probably a good thing taking place at an early stage of the development of the market now.
Yeah, you're looking right now at Adani making his case that there is enough capital in the company. Hey, Mark, do you think that what would you be buying on any kind of dip? Like we see the MSCI India index really getting hit over the last 2 weeks. Where do you want to be buying?
The software companies that involve in software, and more importantly, going forward, India is going to become not only a software source, but a place where high-tech manufacturing takes place. So we're keeping an eye open for companies that are in that space, and healthcare, because people have more money in their pockets, so they're willing to spend more money on healthcare.
Mark, emerging market equity, emerging market debt has been on quite the tear since the beginning of the year. Do I chase that rally?
I would, because I think at the end of the day, the emerging markets are going to look better and better as we go forward. You can already see that the currencies are beginning to recover against the U.S. dollar in a number of areas, and that's good news. And in addition, the growth rate is very, very good in some of these countries. Of course, you can't use a broad brush. You've got to pick and choose. But India, for example, is one great example. Taiwan is doing well, and a number of other markets are doing well.
Hey, Mark, we really appreciate it. Thanks for jumping on the phone with us. We'll get you back when you're in the studio. Mark Mobius, Mobius Capital founding partner. All right, coming up next, we're going to take a look at the wild moves in the bond market. I mean, where are we at here? March 2020. We haven't seen these moves in BTPs since about 2.5, 3 years ago, down by 40 basis points at this point. We'll break it all down for you. This is Bloomberg.
keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The U.S. has won expanded access to more military bases in the Philippines. Defense Secretary Lloyd Austin called it a really big deal after visiting a military base and meeting his Philippine counterpart. It will clear the way for a greater American presence in the region as tensions with China persist. House Speaker Kevin McCarthy called it a good first meeting. After his one-on-one with President Biden on the debt limit, the president responded today at the National Prayer Breakfast.
To start treating each other with respect. That's what Kevin and I are going to do. Not a joke. We had a good meeting yesterday. I think we got to do it across the board.
The president has resisted tying spending talks to raising the debt ceiling, but Republicans want steep budget cuts. Israeli warplanes bombed parts of the Gaza Strip early today. Officials described the targets as a chemical plant and a weapons manufacturing site for Hamas, which Israel describes as a terrorist organization. That comes after a month of bloody clashes between Israelis and Palestinians. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Alex.
Let me pick up. Lisa, thank you very much indeed. Okay, let's take a look at what is happening in the bond market. The bond market moves in Europe are epic. The bond market moves in the United States are worth paying attention to. Ira Jersey, Chief US Rate Strategist from Bloomberg Intelligence, joins us now. Ira, if I take a look at what is happening with rates today, I could conclude that something has changed. Something has changed over the last 24 hours with the Fed, the ECB and the Bank of England. Has something changed with either of those central banks?
Well, yeah. So the Bank of England certainly was more dovish today, and I think that that's probably the primary reason why you're seeing long-term interest rates move significantly lower, because investors are saying, okay, maybe the global interest rate move might be more toward the end than toward the beginning, which, the Federal Reserve, we know is toward the end. The ECB hike today, they'll probably hike a little bit more. But if the central banks are worried about the growth prospects, then it makes sense for the long end of the yield curve to rally, even though front-end yields probably won't move quite as much.
Ira, is it worth, though, if we take a look at just the Fed, for example, is it worth 50 basis points of cuts later this year, which the market is pricing in? I hear you, something may have changed, but is it worth that in the market?
Well, I don't think so. And in fact, Jay Powell explicitly said yesterday during the Q&A after his press conference that his expectation and that the committee's expectation was that they would be on hold for the rest of the year. So, the market is pricing, the way that I read the market right now is that it's basically pricing that the Fed's either on hold or they're cutting even more than 50 basis points by the end of the year, right? So more cutting 50 basis points twice, so maybe 100 basis points of cuts. And then when you take the weighted average of that's how you get the 50 basis points of cuts.
I see.
Ira, we're at what? 336 right now. What's the next target, do you think, to the downside if this move continues?
Yeah, 3.25 is obviously a pretty important psychological level, but 310 to 315 is really important. And if you break down below 315 on a technical basis, you're likely to see sub 3% yields. What's amazing about these markets, Guy, is that liquidity is not what it was prior to the prior to the pandemic. And one of the issues that I think we're just seeing is everyone is one way or the other. It's like everyone is either short or they're long, and now we're getting back to the long side. So all these moves are happening way faster. We expect us to end 10-year yields below 3% by the end of the year, but at this kind of pace, we could be there at the end of the quarter, right, which I think is probably going a little bit too far.
Right, not right now. Did you think that was going to happen? So in terms of positioning, do you feel like this is short covering, or is this fresh money?
Well, so when you look at some of the positioning data from the futures market, for example, speculator positions were actually hit record shorts in the last reading. So when you have short people that short covering rallies like this can kind of pop up on you pretty quickly. So I agree, Alex. Yeah, I think positioning some of this is short covering. So if that's true, eventually it probably won't have the legs to sustain a long-term rally.
All right, gas prices are going up. If the next CPI print is punchy on the upside, how big a reaction could we get?
Yeah, you could see another 20 basis points or 25 basis points the other way in a hurry, Guy. Like I said, liquidity is so problematic that if the trend in inflation turns, right? So we are trending lower in inflation, but if the trend in inflation turns back upward, I think that people will panic sell the market significantly. And in particular, even though we're continuing to what we call bull flatten, so that where the market is rallying and you also see a flatter yield curve, we can start to bull flatten a little bit, where 2-year yields, 3-year yields, those wind up going higher, because in a turn of the market you wind up pricing out those cuts later in the year, and I think that that's really important.
Hey, Ira, how does this set us up for the jobs number tomorrow? I mean, the whisper number right now is 191,000. That's pretty much in line with the survey number. You're laughing. Like, where does this set us up for tomorrow?
Yeah, that's anyone's guess, I think, Alex, because if we wind up getting, certainly if we get a weak number, then this rally could probably be sustained, or at least solidified here a little bit. But if we wind up getting a number 300 and 325 with higher wage numbers, then that ends up probably that could be the impetus for us to see a significant pullback in the market, back up toward 350. So our fair value, in fairness, our fair value model shows us right here, right around 3.3% on the 10-year yield as fair value. But at the same time, that can change significantly if we wind up getting, wage data that ends up being much stronger than expected.
Ira, how does your model compensate for what is happening in the bond market? Bonds are down by 21, 22 basis points right now. How does that plug in to the Treasury market?
Yeah, so our model, to be very specific, actually just uses U.S. data. So what's going on in Europe is only really going to affect things like what goes on with U.S. inflation, U.S. GDP, and the like. So now we have a model to other markets, and what's interesting about that model, and let me just look over here on my Bloomberg terminal right now, is this is actually showing that we should be, because of what's going on in natural gas and oil commodities in particular, when you take where we are in other markets, we should be at 3.6%. And so you have this dichotomy between slowing fundamentals, better data in terms of inflation, saying that we should have lower yields, but then you look at other markets and you look at where we are against currencies and where rates are against things like oil, and that's saying we should be higher. So today's market and treasuries in particular, we're being pulled with what's going on in Europe, right? You have 25 basis point moves in gilts and in boons. The U.S. market is going to follow that, but of course the beta is only 20%, right? Our move, 5 basis point move in our 10 years versus 25 basis points in Europe is significantly different for sure.
Ira, such good analysis. Super appreciate it. Ira Jersey of Bloomberg Intelligence. Coming up, Karen Carnell-Tambor becomes the first female to hold the CIO role at the world's biggest hedge fund. We're going to look at the significance of the leadership changes over Bridgewater next. This is Bloomberg.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Lisa Mateo. For the fourth time in 5 weeks, applications for U.S. unemployment benefits fell. That's underscoring the strength of the job market that threatens to keep inflation elevated. Initial jobless claims fell by 3,000 to 183,000 last week, and that was below estimates. Bed Bath & Beyond has missed interest payments on its bonds. The struggling home goods retailer failed to make payments on notes that totaled more than $1 billion. Bed Bath & Beyond is weighing various options, including a Chapter 11 bankruptcy filing. It was one of the biggest hauls ever for commodity traders at Goldman Sachs. Bloomberg's learned that they brought in more than $3 billion in revenue last year. The unit emerged as a key profit engine in a year when Goldman's net income was cut in half to about $10.8 billion. And that's your Bloomberg Business Flash. Alex.
All right, Lisa, thanks very much. Bridgewater naming Karen Carniel-Tambor as its third co-CIO. The hedge fund is reworking its leadership 4 months after Ray Dalio's departure. Joining us now, Bloomberg's Sonali Basak. Walk us through the significance. There's 3 of them, but Karen's really young, but she's like definitely a force to be reckoned with.
It's an interesting time for Bridgewater, as you say. Ray Dalio had only stepped down a couple of months ago. He was one of the co-CIOs as well. So Bridgewater is pretty used to having a crowded room. They have 2 co-CEOs, 3 co-CIOs. But again, it is the world's largest hedge fund firm. Now, if you kind of look at it, there's a lot of consistency here. She's been there since college, right out of Princeton. She was recruited there by Greg Jensen, one of the co-CIOs. I've seen in another interview that Brad Prince had done about her that he's even said that he could take his spot one day. And so
is that what's happening here? Is this management change? Is this kind of just a long-term management strategy? Get her in. Bob's figuring out what the exit looks like. It looks like Karen.
And remember, we've been talking about these thick ranks that they have. You have Nir Bardia just a couple months ago has told Bloomberg that this transition is a must-win battle. And so you're seeing Bridgewater do what you're not seeing many companies do across Wall Street, which is not even just set your level 1. It's setting all of the levels of leadership into a nice thick stack so that there is consistent succession in leadership here. It's interesting to see her come out of the research division here and then really emphasize research as a key area of, what guides the firm moving forward. Nir Bardia, one of the co-CEOs, also named last year, has only been in that role since the beginning of last year, also has come from that world. And so you're really seeing research lead the ship here at Bridgewater.
Also, wasn't she doing a lot of ESG work for them and analysis too? I think that's quite interesting.
It is interesting, and I would point that ESG is interesting not only from the energy perspective here. I've had Greg Jensen previously tell me that they're thinking about geopolitics a lot in the way that they think about how strategy works at Bridgewater moving forward, how their investment committee thinks about how to navigate these markets. This was a role that really got a lot of its work done at a time where the war in Ukraine really shifted the conversation about global energy. And so she had a key role there. She was recently in Davos speaking about a lot of this as well. But to be very clear, her role is much broader here than ESG.
It always has been, to be honest. We've talked to, I'm a huge fan. We talk to her all the time. She's so smart, but she talks about just about everything. What does this tell us about culture at Bridgewater?
Because she has been there for so long, I think that is an important part of this. Is there a drastic shift in her being there in this role? No, because she's been there for a long time. I think, I want to point out, this is not a story about ESG or sustainability or diversity and inclusion. She's been there since, pre-2008, but she is the first woman to lead a spot like this at the world's largest hedge fund. So culturally, of course, it's a shift. This is a notoriously male-dominated industry. And so it kind of speaks measures for the asset management community, let alone the world's largest hedge fund.
Huge fan. She's amazing. You're amazing. Sonali, thank you very much indeed. Sonali Basak whisking her way back from Florida to join us on set. Okay, stay tuned right here on Bloomberg. In the next hour, Sonali is going to sit down exclusively with Brett Harrison, former FTX US president. That is an interview you do not want to miss. Okay, let's wrap things up in this hour by talking about what's happening in the European bond market. It's pretty, look at BCPs.
Unbelievable.
41 basis points. The ECB just hiked by 50 basis points and signaled another 50 basis points coming down the pike towards us. If you looked at this data, you would not see that story. Peter Pratt, former chief economist at the ECB, is going to be joining us in the next hour. We'll get his analysis on what is happening here. Try and get an understanding of this market reaction. Peter's coming up shortly. This is Bloomberg. Thursday, the 2nd of February. There are days when I firmly believe that the market is always right. Today is a little crazy out there. So the equity market rallying really sharply. DAX is up by 2%. The bond market moves are absolutely epic. We have much to discuss over the next hour. Peter Pratt's going to be joining us very shortly. I'm hoping we're going to hear from the Governor of the Bank of England. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Normally at this point I talk about the equity markets. Normally we'd be talking about single stocks who are right in the middle of earnings season. That would be the logical thing to do, but not today. Today we're going to talk about what is happening in the bond markets across Europe because the moves are absolutely eye-watering on a day when central banks from the Bank of England to the ECB have raised rates by 50 basis points. The ECB signaled that there's another one coming after that. We get this. Gilts down by 25, nearly 26 basis points. Bunds are down by 20 basis points. BTPs, a moment ago, were down by 41 basis points. We're now down by 39 basis points. If you'd listened to the press conference, I know the word indeed, and there's various other kind of nuances that are worth spending some time on. But if you listen to the press conference, if you listen to Bailey, if you look at the statements and everything like that, I'm not sure that this market reaction is commensurate with what we heard from the central banks. So the markets and central banks seem to be on different pages. We've got some really smart guests lined up over the next hour to try and understand, Alex, what is going on here and why we are getting this gap. And I think that that gap is hugely significant on a day like today.
It's sort of reigniting risk, though, all over the place, because you look at the S&P, we're up by 1.4%. You're looking at the NASDAQ, we're up over 3% at this point. And a lot of that is going to be Meta. It's the second best performing stock within the S&P. Sure, I get it. They're going to make a lot of money this year in the first quarter. They wound up boosting their buyback. Is all of that worth a 23% move on the stock after a 67% move from November? So is it possible that you wound up having inline hawkish central banks, which is reigniting some risk appetite within the equity market? On the flip side, to echo what Guy was saying, you're looking at the 10-year down 6 basis points. It seems very mild in comparison, but we're still down by about 15 basis points over the last 2 days. It's the lowest level that we've seen since September of 2022, Guy.
Yeah, the Europeans are making the US look boring today.
I know. It's true.
Sorry.
It's all your fault.
It is. Talking of which, gilts are down by 26 basis points right now. The Bank of England has just raised interest rates by 50 basis points to 4%. It has warned as well that more hikes may be needed. My good friend and colleague, Francine Lacqua, had the opportunity to speak to Governor Andrew Bailey after the decision.
We look at wages as a whole, and I think it's important to do that. So, we are looking at overall wage pressures in the economy. I'm not going to comment on public sector wage settlements, public sector wage issues at the moment, but I am obviously concerned about the economy as a whole. I'm not saying there will be no more rises. Let's be very clear on that, because frankly it is too uncertain at the moment. The fact that we've seen overshoots on what I might call more domestic inflation, and including in that, I have to say, the rate of pay settlements. We are watching that very carefully. Now, there are some indications that in pay settlements are coming off, and the surveys suggest they might well do so going forwards, but we need to see that evidence. We are going to react to the information and the evidence that we see. We haven't pre-announced an intention, because we have reached a point, as I've said before, I think we have started to turn a corner. That's encouraging. There's a long way to go, and there are a lot of risks. The market, of course, was expecting us to hike by 50 basis points, so I don't think they will have been surprised by that. I think the market will also be focused on what we do next.
That was the Bank of England Governor Andrew Bailey. So to the question, was that worth the 22 basis point move that we're seeing over in the gilt market?
That soft string was worth it, definitely.
You're mocking the soft string. This just feels cruel.
Just feel a little unfair. The market was expecting 50 basis points. We got 50 basis points. I think on balance, maybe the initial statement was a little more hawkish than anticipated. They did, though, change some of the forward guidance in terms of the language that they used, and it seems that it's the latter that the market is latched onto, rather than we need to do more from here. I think the market very clearly is signaling today that there's a distinct possibility that they could be done. We maybe get 25 basis points more, but that's kind of it. And you almost get the same feeling with the ECB today, judging by the market reaction. It's very peculiar.
Well, but I also found that the growth projections didn't fill me with tons of confidence for
Yeah, it's grim.
I mean, it's pretty grim. Yes, okay, the recession's only going to be 5 quarters rather than 8, okay, and it won't be as bad. But the long-term potential is pretty terrible. What, we're looking at 0.7% growth for the next 3 years?
So what I think is interesting is that the Bank of England is actually more pessimistic on the recovery than the IMF is. And the IMF is pretty pessimistic.
Yeah. And there's no easy fix for that. I get that some of it's Brexit, but they talked about how people aren't coming back into the workforce after COVID, and the actual economy is just smaller now, and there's no easy fix for that.
Loads of over 50s have left the labour market.
Yeah.
And it's unlikely that they are going to come back. One of the biggest challenges for the UK government is going to be how you sustain an older workforce. It's a challenge for everybody in terms of most of the developed economies, but the UK feels like it's a real problem right now.
So in that case, I wonder, is the BOE in a position, because you make the argument on the one hand,